Okay, good afternoon, everybody. Welcome to the Take on the Market. Today is April 14th, 2023. It's about 1:45 Pacific time, so the market is closed for a little bit here. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD that I'm aware of is licensed. I cannot tell you what to buy, sell, hold, how much to have, how much not to have. Should you own gold? Should you own bonds? What should you do on vacation? But these are questions that I get a lot. And so because this video, and I get these questions, mostly via email, because this video is pre-vetted for compliance, I can speak a little bit more freely on this video. So please take a moment to understand this disclaimer. Okay, so market thoughts. Then I'll go through a couple of the common questions that I get via email. Industry groups, just barely. There not much has changed there. Stocks to watch, and then the quote of the week. So market thoughts, and bear with me here. Make sure I'm recording this. Make sure I'm sharing correctly. All right. So, you've probably heard it a million times, but the market is tightly wound amongst just a handful of stocks. And when I say market, I mean the indexes. So Microsoft, Apple, Google, Amazon, et cetera, 7 companies make up over 50% of the NASDAQ 100. NASDAQ 100 is the QQQ ETF. So 7 of them. I don't know how many are in there. I guess it's 100, right? How novel. Although I did hear that the S&P 500 has 499 or something like that. So, if somebody gets bought out or something like that. So it's close to 100, or if not 100. So it's highly concentrated. And it's been a great strategy for a long, long time. There's a reason Apple, Microsoft, Google, et cetera, have become so concentrated, because they've done so well. These are great companies. Stocks have gone up. And so they've become a bigger portion of these indexes. The indexes, they have a strategy of, kind of like we do. They add to their winners and they cut their losers. So sometimes they delist companies that haven't done well, that are on the verge or in bankruptcy. And other companies that, if they're not making progress, they don't become larger portions of the index. So it is what it is. There's a yin and a yang to it. We're all aware of it. You think about it when you're making your strategy, when you're thinking about how I'm going to allocate my capital to stocks, how much am I going to be invested, how much weight am I putting on the index to make decisions. The indexes are highly skewed. It's not telling a great story currently. The S&P is the same. The top 5 stocks, market cap in trillions so far, over 1.3 trillion. The next 15, 0.75-ish. And the remainder, just barely above zero. So of the, 20 stocks make up 90% or more of the gains this year. How would you trade that? What would you do with that? I don't know. I don't know if I would do a whole lot with it. I just want to be aware. It's partly why I don't think the indexes tell the best story anymore. There's 2 schools of thought. I understand the M in Ken Slim, and the M is very important. If you have a massive headwind or a massive tailwind, that M is going to move your stocks. And 2020 was a massive tailwind and everything went up. And then it became a massive headwind and pretty much everything went down. There's a saying, even a turkey can fly in a windstorm. So there's a lot of turkeys flying in the 2020 windstorm. And it was a great time to be invested. I had my best year ever in a cash account in 2020. So I love it. I'm glad it existed, but I'm also, a tiny bit skeptical and know, I've been around and a student of history and know that it can't last forever. So when you get into these types of environments, you kind of want to know where the exit is. Doesn't mean you have to exit. You just want to know where it is. That's why we have a plan to exit our stocks, I think. So, and then Mark Minervini would say that what if the indexes didn't exist, which I think is a very, very fair point. What would you do? And I hearken back to the man on the mountain story from Reminiscences of a Stock Operator, a guy who would come down every once in a while from his cabin and buy or sell stocks. He didn't know what the indexes were doing. He didn't have a NASDAQ. He didn't have futures or anything like that. You just come down and see what their prices have been doing, and make his bets, so to speak, and then go back and rinse and repeat. And he did tremendously well doing that. So you don't have to have a perfect market to make money. I think the markets have probably made their lows, probably, not for sure, but probably. It would not shock me if we made new lows in this environment. It would surprise me a tiny bit, but it wouldn't shock me. And then I think they've made their highs for a while now, and so it wouldn't shock me if they made new highs, the indexes, in, like, let's say 6 or 9 months. It would surprise me, I think, but it wouldn't shock me. So I don't have to have either one happen. If the market does nothing, then I think good companies will make progress, and there's always kind of something going on. There's a lot of money out there, pensions and mutual funds and stuff like that never leaves the market. So that's kind of why you get this washing machine effect. They're always looking for ideas. So hopefully we can learn to get on board those. Okay, so before I go to the indexes, before I go to questions, let me pull up the indexes. So here's the NASDAQ. And, it looks fine. It's not going up a lot, but it sure doesn't look bearish, right? You've got a higher low right there. And so this is the low I was talking about, which I would give probably like a 25% chance of being undercut in the interim here, 6, 9, 12 months. I just don't see it being undercut. And here's the high, and I think it's even less of that being overtaken, maybe 10%. So I think we just trade right in this huge zone. And so if you have something you like, you buy it. And if you have something that's not acting right, you sell it. And rinse and repeat, and just keep doing that. And you might find that you can make progress in leading stocks. How many stocks do you need to own? Very few. I rarely own more than 8. I mean, I can't remember the last time I ever owned more than 10. I'm sure I have, but it's been a while. And so you can see it's pretty tight. The market's just kind of sitting here, and maybe it's gonna, do something where it comes out of here like that, one way or the other. I don't know. I just don't have a lot of conviction on either side as far as the indexes are. So it's just very low on the totem pole of my decision making. Decision making for me is really simple. Am I making progress? One. If I'm making progress, how are the leading stocks acting? How are the stocks that I own acting? And that's like a third, something like that. And honestly, I probably even more weighting is how well am I doing? It's like a baseball player or a golfer. Sometimes you're seeing that ball and you're just seeing it. You're doing well, and sometimes you just can't find a swing. And so I always like to think, am I seeing the ball? And if I'm doing well, I want to be aggressive. I want to press. And as soon as I stop doing well, I want to pull back, slow down, stop, hit the brakes, and just go back and forth from that, doing that. The S&P, very similar to the NASDAQ. You've actually got 1, 2, 3 higher lows on the S&P. So it's holding up okay. What else should we, how about the Russell? IWM, not as good, and that's because it has that banking exposure. So it's not doing as well. Well, I doubt any of us own any banks. There's been no reason to own any of them. It's because they haven't been performing. Okay, so let's let's minimize this. So I often get email questions, and I'm almost always I cannot answer them due to compliance. Now this video is vetted for compliance, so I can speak a little bit more freely on these. So a handful of questions I got this week that were, what about volume? XYZ didn't go up on volume. What do you do? XYZ, it didn't go down on big volume. What do you do? And so on and so forth. So volume is a common question I get. Vacation, and I'm going to answer this. I have a little screenshot for volume, but for vacation, in this day and age, I don't think you have to be with these things. You can be, unfortunately or fortunately, attached to the market very easily. So I don't make too many decisions based on vacation like I used to. I used to just go to cash on vacation, and there's nothing wrong with that too. Clear your mind. The markets aren't going to go away. There'll always be a chance to come back to it. Speaking of reminiscences of a stock operator, there's Jesse Livermore would go fishing a lot, right? So there's a time to be investing and time to be fishing. But I did go to Spain and was in Mallorca, and we did 2 boat trips. And so I knew I wouldn't have access to the markets all day. So, I might put some staggered stops in there. I might reduce my positions just because I want to have a good time. I don't want to worry about my stocks. So, that's probably how I would say the best way to handle that. A lot of it depends on where you're going. Like I went out of the country. I went to Spain. So it's a little different in that regard versus if I, just drove to San Diego for the weekend. If I went to San Diego for the weekend, I'm not going to have to worry about doing anything like that. As far as bonds, I had people ask about that. You're going to have to call your broker. Once you learn how to do it, it's pretty easy, but your broker will walk you through it. I had TD Ameritrade show me how to buy bonds. I like to buy the new issues, be part of the auction. Once you do it once on their website, you'll find it's pretty easy and you can keep doing it. And then Fidelity, their system's almost exactly the same kind of process. So, when I'm sitting in cash, and I never used to worry about this too much because the money markets were all zilch for so long, but they're not zilch anymore. So, I have real money that's sitting at, 0.35% at TD Ameritrade when I can make 4.5% in a short-term bond. I'm going to do something about it. So I called TD Ameritrade to figure out why the money market was so low. And look, they have to make a living too. They got to stay in business. I get it, but not on my dime if I can help it. So yeah, I would contact your broker. They'll show you how to do that. As far as volume, so I've created this little fake scenario of XYZ Pharmaceuticals, and let's pretend that I own all of the company. For whatever reason, I own all 10,000 shares, and Fidelity Magellan comes in and decides they want to own 10,000 shares of XYZ Pharmaceuticals. Stock's currently 100. Well, I'm willing to sell 500 shares at 101. And so they're bidding at 101. They see the price at 101, and Fidelity says, okay, well, we're a buyer of 10,000 at 101. Well, here's 500. Okay. So now they have to decide what do they want to do with the 9,500. They can sit there and hope I change my mind, but now the stock, because they get anxious, now the stock's 102, and they're a bidder of, I didn't put that in there, but 9,500 at 102. And I might say, well, I don't want to get rid of any more, but here's 100 shares at 102. So now they're down to 9,400 shares, and stock's gone from 101 to 103, and it's barely traded, 600 shares. So now I might say, all right, I'll give you 1,000 at 103. And so now they've gotten 1,600 shares, but now the stock's 103. And I might say, and I'm pretty much done. And so they say, how about 104? And at 104, I'll give them 400 shares. So now they've got 2,000 shares and I've got 8, but they still have 8 they want. And at 105, I say, I'm not interested. I don't want to get rid of any more of my shares. I think it's worth more. And at 106, I'm still not interested. See how stocks can move on no volume, right? In this scenario, the stock could literally go up on no volume and it could go down on no volume. This can work in reverse. And so that's why I don't really worry so much about the volume. If I want to own the stock and it goes through my price, I don't even look at what the volume is. Now, I know Arusha Pires at O'Neill, he likes to consider the volume, and a lot of my colleagues I know talk about volume. So I'm not saying I have the right answer. I'm just telling you how I do it. I just like to keep things simple. And so you can look on a MarketSmith chart, and it will tell you what the volume is going to be like at that moment. It will calculate a run rate based on how it's normally trading. Problem is the stock might ramp up volume or it might slow down. And so, you have to take that in consideration. The longer you are into the day, the more likely that number is to be correct, right? Obviously. And in the early part of the day, you can see some big numbers because, it's the stock volume is not linear. It's more like a U. It's U-shaped. So at 107, I might say you can have 1,000. Now it's 108. Now I'm more of a willing seller because now it's reached my price where I think it's, this is where I was planning to, to sell it. And I'm willing to give it all to them between 108 and 110. Well, if you were watching this, you would see this huge rush of volume come into the stock at 108, 109, 110. And now you have your volume footprint you were looking for, but the stock's now $10 higher than you wanted. Now, I just did it this way just to make the math easy. Imagine it's 10 cents or 20 cents or whatever. So this is why I think if you want to buy it, and let's say I want to say there's 3 of us now. There's my uncle owns the 10,000 shares, and I know he's doing a great job over there. And Fidelity wants 10,000. I don't know that. But I'm watching the stock at 100 and I want to buy 500 shares. So it's 101 and 500 shares goes off at 101 and I don't get filled because Fidelity got it. And now it's 102. Well, I can go in there like a PT boat really quickly and buy that 100 shares at 102. Now it's 103 and Fidelity sees that and they grab the 103 really fast. So now I have 100 shares at 102. I want 500. So I'm going to go grab that 400 shares at 104 fairly quickly. Now I've got my position. So you can see how you can trade with these institutions at the price you want in smaller size. You don't have to worry about the game that they're playing as far as the big size. So I hope that makes sense. I hope this is food for thought for you. If you're worried or if volume is keeping you from, making decisions both in and or out of stocks. I know the volume footprint is important and I'll look at it at the end of the day. Let's see what the volume is like at the end of the week. How did the stock close? Stock close strong, volume big. We'll look at some stocks later. But in the heat of the moment, I just want to get my stock because there's nothing more frustrating than to see something I want to buy go from 100 to 110 and I'm waiting for the volume to come in. And now the volume comes in, so I pay 110. That doesn't make sense to me. I don't know. It just doesn't make any sense to me. Why not just buy some at 101? Because if it goes up, I'm going to buy more. I'm going to add to my position. And if I'm wrong, it's okay. I'm going to be wrong small. I don't mind being wrong. I'm wrong a lot. I'm always probing, looking for things that are strong and or weak if I'm thinking of the short side. And I'm buying, these positions to see if I can get any leverage on it, where I could add to it and get a little bit of a cushion, add to it and get another bigger cushion, and then really try to press it if I think it's going to go. Okay. All right. So stocks to watch. Pause share. I do not want to mess this up. I mess this up so much. It takes me 2 or 3 tries to do this video all the time because I mess this up. I know, and we're not going to do industry groups for the sake of brevity. I would take a look at them for sure. Semiconductors, gold. There's home builders. There's a diverse area of stocks that you can own. So, take a look. I would definitely look at those, but I'm gonna skip that at this moment. Okay, I'm screen sharing. Great. Okay, so I've got kind of 3 areas or 4. I forgot about the gold ones that are kind of sticking out to me. So like in the growthy stock universe, you've got I'm gonna turn my video off so you can see the charts better. You've got Shockwave. Now they made an announcement, bought some company, and the stock jumped up on that news. It's building this really large cup. I wouldn't buy it here if it ran up there. Like to see a handle, but you can see the volume footprint was good. Stock closed at or near the highs. And, you had this really strong day on that news, that gap. It's not the greatest, most ideal buy point. It's not, you're kind of just, going along for the ride when you see that. But and this is a stock that's always on my radar, at least so far for the last few years because of this. Their earnings and sales have been really, really strong. It's just for whatever they're doing is pretty powerful. So this looks very interesting to me. Let's open up the panel, and you've got, some ownership. It's kind of spotty and small, which is both good and bad. If they change their mind to add to it, then they could drive the stock a little bit more because they don't own that much so far. Okay, so Suave, ANET. ANET didn't have, I didn't realize it didn't have quite a day today. Market was really choppy. Like it opened down, ran up really strong, and then collapsed. There's probably a better word for the collapse, but you get the idea. It came down really hard, and then it tried to rally at the end of the day. So it's very, very strange day. But ANET missed the last rally. But this is a really good stock, earnings and sales, right? Big return on equity, huge proprietary rankings, super quality. And it's just starting to come out of a very long consolidation. So this could be, if the market gets legs, if we get a bull market, this stock's probably going a lot higher. So ideally, I'd like to see that, and maybe in a week or two you will see that. They'll meet, say they meet at 160-ish. Now you have earnings in 3 weeks, so you'll have that to tackle, to consider. But this stock's definitely a leader. ALGM, leader right on the 50-day. ACLS, leader right on the 50-day. And then last but not least, in the kind of the big cap territory, you've got Google, which broke out, pulled back, and then rallied today. I know Elon Musk mentioned today that he's going to do an AI startup, and so AI is all the rage. And I'm not an expert on AI by any means, but I doubt that Google is just sitting back. I'm sure they're all hands on deck as far as AI. So one thing I like about Google is quality company, first stage base. It's had, a pretty good pullback. It's 17% off the 52-week high, but it's probably, I would guess 40 from high to low. It probably corrected 40%, 151 down to 83. Gosh, maybe even more. Does that? Yeah, so about 45% is its correction. So you're buying quality, and I think I talked about last video how sometimes why not buy these types of stocks when they pull back like that. So it's a nice offset against my Tesla short. It's going to be really hard to make money on both, and probably really hard to lose money on both. Let's hope. And I'm thinking, like, if we get into a big bull market or we get into a big bear market, now if we get into just the sideways thing, then I think Google can go higher, and I think Tesla can go lower. That would be the ideal scenario. So Google in that regard. On the mining side, FCX looks very interesting to me. There's a good article in the journal today. I talk about the journal. I think it was Daniel Yergin. He called it big shovel versus big oil. This is, I think it's a must read. By 2035, all new cars sold in California are going to have at least 2.5 times as much copper as conventional cars today. Why? Because of the electrification, right? They need so much more copper. So this digging these mines, it's just not that easy to get all the lithium and cobalt and copper out of the ground that we need for this massive electrification that we're going to. Now, I would say that the odds of that law sticking are probably slim and none, but it's amazing what a little government incentive can do if they put their mind to it. So, the incentives for EVs have been crazy for a while, and I don't know what it contributed to the big move in Tesla, but it made a difference. It was an added fire, fuel to the fire on why Tesla stock made such a large move as these incentives. So I like this type of area. FCX and SCCO, I own both of these. They're highly correlated, I would guess, if probably 1-to-1. I don't know why you need to own both, but I do. And maybe if they both start to move after a number of weeks, I'll decide which one seems better and maybe peel off one or the other. But or what I have done is I consider it kind of one position. So it's, if I want a 20% position in this area, I can do 10 and 10 in each stock. I'm not going to do 20 and 20 in each stock. So this looks very interesting to me, this area. And then you've got like gold, which, is, let me turn my video off so in case it's covering the computer. I'm sorry, the screen. But AGI is, just these number of weeks up in a row. So yeah, there will be some type of pullback, but this group looks interesting to me. Like it's a number 4 group. And it's a lot of the small ones. KGC has moved really well. I don't really know too many others. There's a new one. I can't remember. OR has done really well. What is that new one? It's T. It's like a new issue. Bear with me here. Starts with a T. There it is. Triple flag precious metals. Very interesting. Comes out, goes sideways, comes out. So this one looks good too. This is like a streaming in royalty. So if you're interested in gold, there are a couple of gold stocks that are holding up pretty well. And then energy, you've got like PBR. Not quite a double bottom on the weekly, but to me it was. And I watch this stock pretty close because the yield is really high, and I've tried to own it a few times. But when it came out of this little double bottom here, then I was a buyer. And Brazil did pretty well, had a pretty good week. And then HES looks interesting. Tidewater holding up really well. Maybe this, if we fast forward, will be a base. Weatherford, fast forward, maybe this will be a base. Need some time. But they're out there. There's names out there. I haven't even got into like the home builders and like BLDR, I think is doing pretty good. Yeah. So there's stuff out there to own. So I think you want the main message is not worry so much about the overall market. If you see something you like, if it's setting up, go with it. You have your stop loss plan and rinse and repeat. All right, so I'm gonna pause the share, resume the share, quote of the week. From Bruce Kovner in Market Wizards. Michael Marcus taught me one other thing that is absolutely critical. You have to be willing to make mistakes regularly. There's nothing wrong with it. So I remember I think it was on IBD Live, people were talking about PBR and well, it's got a lot of risk. It's this, it's that, it's Brazil. And yeah, there's a lot of risk. There's risk in the market. You want to be able to build that into your model and acknowledge it, but you don't want to be afraid of it. That's how you get paid, is by taking on that risk, because you have that potential for reward. So you have to, if you're afraid of the risk, you might not be the risk you're afraid of. It might be that you're afraid to be wrong, which is something you probably want to get over in the markets. There's nothing wrong with being wrong. Make a mistake, move on, try again, move on. And what Bruce Kovner says, Michael taught me, make your best judgment, you're wrong. Make your next best judgment, wrong. Make your third best judgment, double your money. And that's really what this is about. It's not about being right or wrong. It's about, trying to get a foothold in something really good and doing really well when you get it. And you can be wrong more often than right, by doing that. So you have to be willing to make mistakes. Don't be afraid of mistakes. Just make sure that you correct them, right? Bruce Lee says, mistakes are always forgivable as long as one has the courage to admit them. And so you just admit, hey, I was wrong, and move on, and then try again. All right. Thank you, guys. Hopefully everybody has a great weekend. MarketSmith@investors.com, 800-424-9033. I think we'll be back next week. Have a good one. Bye, everyone.